Listen to Mr. Peter Lynch. Peter Lynch, as every one of us know, is one of the greatest fund managers we have ever seen. His method of investing intrigued everyone, not because they were complicated, but mostly because it was so simple yet effective. In one of his videos, Mr. Peter Lynch says this.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens.
Hello everyone, I'm Rakshit Pai and today's video is on the market will fall at times. We can and should do nothing about it, but find opportunities. Just recently, I read an article by Mr. Ankur Jhaveri. The article was titled, "Your portfolio will go down." In this article, Mr. Jhaveri and his team have done an analysis on the Nifty 50 for the past 23 years to see what kind of ups and downs we can note in the market. I put the article link in the description, do check it out. Anyway, the outcome was shockingly similar to what Mr. Peter Lynch said during his tenure as a professional fund manager. The outcome was that the market will fall 10, 20, 30 or even 50% at times in a single year. In fact, as per Mr. Jhaveri's analysis, over the past 23 years, that is from the beginning of 2000 to the end of 2022, 19 years had ups and downs greater than 20%. And we thought 20% meant we were in a crash zone, right? However, when the market fluctuates so frequently, it has become a norm. The year 2019 had the least fluctuation in real terms with a 14% move, and the year 2003, 2008, 9 and 2020 had the highest single year moves ranging from 46% to over 65%. What does that tell you? From the year 2000 to 2022, the market moved by 20% or more in a single year nearly 87% of the time. And almost 50% of the time, the market has corrected over 30% in a single year. So basically, certain years, mostly in and around the market crashes, provide us with an once in a decade opportunity to make money. I mean, hefty money. The year 2020 was an example. Just look at how aggressively the market fell, and with double the aggression, the market recovered. Everything was right in front of us and we had very little control. One more interesting point I noticed was that if you had invested during the peak of the market, you would have still made money even if after the crash, because the market recovery post-crash will be that much more aggressive. This fact is true for both the tech bubble crash in the year 2000 and the 2008 financial crisis, as well as the recent 2020 COVID pandemic crash. All you had to do was to stay committed and stay invested throughout the market cycle. Thus, it is proved without a doubt that the way to not lose money in the market is staying invested. And one of the easiest way to invest is to invest via ET Money Genius. Their track record speaks for themselves. More on ET Money at the end of this video. Does that mean any investment will make money? Well, it's quite contrary. In fact, the stats we just reviewed are for the overall market, specifically the Nifty 50 index. If you were to invest in any company, then these stats would change completely. Because we have seen companies that crashed alongside the market but never to come back up ever again. I have explained this in one of my short videos. Check this out. The closest way to mimic the broad market is by owning large, financially strong blue chip companies, or simply invest via index funds, because they will trend alongside the market in most cases. So when you see market correcting, it's the same TCS, Kotak Bank, Infosys, Reliance, HDFC Twins, etc. that fall, and it's the same companies that recover stronger than ever before. Isn't that what we mean when we say the big are getting bigger? Well, they do. This has happened over and over again. It'll happen now and it'll happen in future too. I'll conclude this video by giving one last tip. We all want to explore the market because the market is interesting. But in the stock market, our main goal is to make money, right? Money earned in a single year does not produce much wealth. So the most part, what's suggested to retail investors is to invest in financially strong large cap companies, those that are household names, and allocate at least 50 to 70% of your portfolio in them. The balance 30% is for you to stretch your comfort zone and go value hunting, little bit of speculation and a little bit of trading, and so on. I hope the video was informative. Now let's see what 80 Money Genius is all about. Hi there. Do you take stock tips, invested in them, lost money? Well, instead of repeating the same mistake, earn better returns by subscribing to 80 Money Genius. 80 Money Genius will understand your risk profile and suggest different investment options for varying time periods, thus helping you build a very well diversified portfolio. High quality stocks that yield better returns are chosen so that you need not wait for years. So what is the expected return? Well, if you had invested as per the 80 Money Genius high growth stock strategy for any 7 years in the last 15 years, you would have earned 22.4% CAGR. The wait ends here because with no additional work, you can earn a wonderful return just by subscribing to 80 Money Genius membership. Check the link in the description. Thank you for watching.